Okay, so next Tuesday will be our uh first exam. Okay, it's in the evening. Okay, not in the morning. Okay, 8:30 p.m. at C135. Okay, the largest hall in the first floor. Okay, one and a half hour. You can have one single-sided uh A4 cheat sheet. Okay, calculator also allowed. But really don't bring other communication devices. Okay. Okay. So yeah, I can give you one example. This is actually what I used when I was an undergraduate. So you can even see my student number. It was so early, right? 10 years ago. So you can see that basically we learned something similar. Okay, that's a little bit different in the interest rate part. Okay, definitions, functions. Why we use the ERT? Basically, that's a limitation approximation. Okay. So here, like a LIBOR, this is something more a bit outdated now. Okay. Now in your textbook, we don't have LIBOR anymore. Okay. In my old textbook, LIBOR was the reference for risk-free rate. Okay. So you can see that further right here is the table. Right. You can see in chapter 2, right, the difference between forward contract and future contract. Okay, like here is a capital 5, right? How to price the future contract. Okay, R minus Q, there is a foreign currency interest rate minus there is a local currency interest rate minus the foreign currency interest rate. Okay, so many kind of things like that. So later that those are options. Okay, I actually this are not really the cheat sheet. I have several pages. Okay, I use that for review, and actually in my year we don't allow that. Okay, but for you are allowed for one page. Okay, something like that. Okay, the other side you are not allowed to have anything. If you have anything on the other side, okay, I will ask you to slice it into two parts. Okay, only bring one part. Okay, so everyone should have the same information advantage. One single-sided A4 cheat sheet. Okay, that's it. So, okay, that's about the exam. Okay, so we're gonna finish this chapter today, and how maybe we have 5 or 10 minutes for chapter 3 a little. We can only touch it a little because we have more to talk for this chapter. Okay. Today our job is to finish chapter 5, conclude cost of carry, and there are two more points we want to include. So forward price and future price differences, and the relationship between future price and the expected spot price. Okay, and also we want to have one example to let you see after you learned how to determine the future price, what can you do in the market. Okay. So in chapter 3, maybe today we can only talk about long and short hedge, necessity of hedging. For basis risk, maybe we should leave it to this Tuesday. But for this chapter, I think the content is not that hard. So this chapter 3 is not that hard. So hopefully this Thursday we can finish everything. Then next Tuesday we won't have anything new. Okay, then the session here will be purely a Q&A. Okay, so I won't teach anything. I won't say anything. If you have any question, you can come. If you don't have any questions, you don't need to come. Okay, next Tuesday. Okay, but come to Thursday, we get back to normal. Okay. Later I will update the schedule in Canvas. Okay. All the schedule we follow the announcement in Canvas. Okay. Right. Uh, just simply conclude. Okay. Cost of carry is include almost everything is except the convenience yield. Okay. Cost of carry here. Okay. Straightforwardly, it considering about the cost when you holding the asset to a future time point to the delivery date. So this is like the cost for the short hedger to carry on this asset. Okay. So it is definitely interest rate is one major point, major components in the cost of carry, right? Because if you spend a certain amount of money to purchase this asset, right? As long as the time pass, you hold the asset, then the asset's monetary cost actually got a little bit because of the interest rate, because of time and value of money. Okay. One small point I want to mention is, okay, we use a risk-free rate for some reasons, right? There are different ways, different explanations for this risk-free rate. Okay, so one's very uh, simple but a bit theoretical way is we tend to argue the determination of future price based on the arbitrage opportunity, right? We use arbitrage opportunity procedure. We set like two ways to arrive at the same result, right? Holding the stock. Okay, then comparing these two ways, as long as you have the same result, you should have the same cost. Okay, we do that kind of argument, arbitrage opportunity argument. So arbitrage itself is basically riskless, right? It is although there will be some difficulty for you to implement the arbitrage, but that difficulty is all about like market friction. But so there is nothing about uncertainty about the future. So in terms of risk, okay, in terms of risk uncertainty, we have virtually no risk with arbitrage. Okay, then theoretically the conclusion is quite simple. Once you have a riskless procedure, then the discount rate in this procedure should be the risk-free rate. Okay, so if your investment is a risky investment, then your discount rate should also be in accordance with the risk level of this asset, right? But if your investment procedure is an arbitrary procedure, it has virtually no risk. In that case, your discount rate should be the risk-free rate, right? Do you have the match between risk and return? This is one theoretical way, very simple. A more practical way, okay? Alternatively, you can understand in a more practical way. So the practical way is, although for you and me, maybe for individuals, right, it's very hard for us to run those arbitrary opportunities because our borrowing rate will very unlikely to be the risk-free rate. We tend to have a relatively higher one, okay? But the largest player in the derivatives market include both futures options swaps. Okay, the largest players are commercial banks, investment banks, those very large multinational banks. Okay, they are virtually no default risk, and you know in later chapters we are talking about how to determine the risk-free rate curve. Okay, in my age, the reference for risk-free rate is LIBOR, London interbank offering rate. So it was basically defined by all those commercial banks who are exactly the players in the derivative market. Okay, London, the LIBOR, basically each day in London at a certain time point, okay, each bank will have a report, have an offering, say that, okay, today in my bank, I will offer a risk-free investment with a certain what interest rate, okay? Then the London exchange, they will calculate an average, publish it. That's a LIBOR rate. Okay, so you can see that those determine the risk-free rate. They are also the largest player in the future market, right? Even comes to now, LIBOR is a very less a very less use. The alternative is still the same. Alternative, if we use the OIS interest rate, the overnight interbank swap rate. Okay, still that is determined by those large commercial banks. So those banks, those determine the risk-free rate, they are also the players. Okay, so it is very intuitive to assume that they will borrow and lend in the risk-free rate, and they will maintain the fairness, this determination here. Okay, so this is about cost of carry. Okay, in addition to risk-free rate, you can add a lot of other things, storage costs, dividend income. For bond, you can coupon income, right? For foreign currencies, the foreign currency interest rate, those are all kind of income, positive or negative to your to the asset holder. Okay. The convenience yield here, we typically don't include the convenience yield into the cost of carry because in terms of concept, okay, convenience yield is a bit incompatible with the cost of carry. So we tend to single it out. But the function of cost of convenience yield is just like will be shown in the slide, right? It will reduce future price according to the scale of benefit you can enjoy with consumption asset. Okay, so oops. We have two more points. Okay, one point is about the forward price and the future price difference. Okay, until now, we tend to mix up the forward price and the future price. Okay, we tend to mix them together, say, okay, they are very likely the same. Okay, in practice, this is also true. Because the designation of both contracts are virtually the same, although the requirements are slightly different. Okay, although the future contract have the daily settlement process, have the margin account. Okay, those are very distinctive. But by the end, they are all about having the transaction in the future time point. Okay, so in normal cases, okay, future price, forward price, all the same. But in some cases, the situation can change a little. Okay. Well, this is mainly because that once the future contracts have the daily settlement process, okay, in the margin account, the margin balance, you have a kind of a real time, not really real time, but at least a daily reflection of your gain and lose. And this gain and lose, let me alert you a little. This gain and lose actually have some monetary cost. Okay, for example, if the markets move in the direction you expected, okay, very likely your margin account about the future contract will have more and more money, okay, in the margin balance. This margin balance do have some interest rate, right? Okay, because that margin account is managed by your broker, right? You get those additional one. Okay, you can redeem that to invest into other parts, or you can just put it in your broker's account. Then naturally your broker should pay you some interest rate, very likely the risk-free rate. Okay. In that case, the interest rate of this additional money will make your future prices a bit different from forward prices. Okay, let's take one example. Very realistic. Okay, if your underlying asset is a bond, okay, everyone knows, right? Everyone knows bond price have a reverse relationship with interest rate, right? So your bond price have a negative relationship with market interest rate. So as let's say as 0, this is a bond. So if you hold a future contract for this bond, okay, today you agree to have F0 here according to the S0. Okay, this bond future contract. Several days later, the bond price increase. Okay, as a long holder, your future contract will bring you some benefit. That means your margin balance also increase. Okay. So here on this side, since your bond price have a negative relationship with interest rate, bond price increase, very likely the market interest rate actually decreasing. That means what? It means although the balance in your margin account increase, but the interest you can earn with this portion of additional money is actually less because of the decreasing interest rate. That means what? Means this negative relationship actually reduce your benefit with the future contract. Okay, the opposite is also true. Okay, if you go to the opposite way, the bond price is decreasing as a long holder. Okay, your margin account also has less and less money over time. Very likely, you will trigger a margin call if the bond future price keep dropping. Okay, once you trigger a margin call, what is the consequence? You need to find somewhere where to get some additional money to fill into your margin account to fulfill the initial margin requirement, right? Then to allocate some money from somewhere else to your margin account, okay? Sometimes you need to borrow. Then if you borrow, you have your borrowing interest rate. If then once you mention borrow, okay, you mention borrow, so borrow have its interest rate, and once you have a negative relationship and the asset price is dropping, that means currently the market interest rate is high. That means once you want to fill in your margin account with additional money you borrow from somewhere, this borrowing cost is actually quite high due to this negative relationship. That means what? Once your margin account is losing, okay, considering about your borrowing status, it even make your situation worse because your borrowing cost is high. Okay, so the whole conclusion is once you have a negative relationship between your asset price and the market interest rate, very likely your future account will have less benefit than expected, and the loss can be more severe because of the exacerbated interest rate in borrowing. Okay, so this is our conclusion here. If you have a negative correlation between interest rate and asset price, then the future price should be lower than the forward contract. Okay, if you have the reverse relationship, if the asset price have a positive relationship with the interest rate, then your future contract actually should be more beneficial. So the future price, the F0 there for that future price should be even higher than the F0 for the forward price. Okay. But in most cases, the relationship are not that significant, and we do have many other different factors affecting the future price simultaneously. So it's still safe for us until now to assume that forward price and future price are almost the same. Okay, we just mentioned what some exceptions to recall your attention. Okay. Well, the last point is about the relationship between future price and expected future spot price. Uh, just call it from the name list. 刘劲峰. Hi, 刘劲峰. Have you take the 4300 investment course? Yes. Okay. So a small thing I want to recall, there is one model in 4300 telling you that we can predict the expected return of any asset according to its exposure to systematic risk. What is that model? Any idea? Okay, Jimmy, I asked you before, so hmm. 王若欣. Yeah, you took my class, so I know. Yeah. Which model? Which model predict the expected return with the exposure to systematic risk? Four letters. Yeah, CAPM, right? So capital asset pricing model. It runs in this way. Right. So the determination of your expected return on the asset have two components. First is a baseline uh, return. This should be the risk-free rate in many cases. The other is a measure for risk premium according to the market rate. Okay, because the unsystematic risk of any asset should be easily diversified throughout holding a large enough portfolio, right? So only systematic risk counts when you measure the risk of one asset. So then your exposure to this market risk, here in total, we call this your exposure to market risk premium, exposure to systematic risk. This determines your overall risk level. And based on the very simple high risk, high return principle, right? This should determine the level of your expected return, right? This is kind of something you should learn before this class. Okay. So, 向成轩. Okay. There are many ways to do the fundamental analysis for a firm, right? Many different models. Okay, give me one example for those models to do the fundamental analysis for a firm to determine the fair value of a firm's stock. Give me one example. Yeah, okay, good job. Nice, good job. Okay, free cash flow model. Typically, the model says the company's present value is depending on the discounted free cash flow in the throughout all their future uh, living period. Right. Okay, let me know your name so I won't repeatedly ask the same person. Okay. 钱亦可。哎，so what kind of discount rate we should use here for any model? This is a free cash flow. You can use others like dividend or residual income. But anyway, I'm asking you what kind of discount rate we should use here. What is this discount rate? It should depending on what things. Okay, take it simply. Oh, you say what do you want to say? Sorry. Uh-huh. Given? Okay. Okay. Take it simply. Okay. Give me a yes or no answer. Okay. Is this the risk-free rate? No. Why? Okay. Okay. Roughly good. Roughly good. Okay. So you are discounting the firm's business, right? The firm's business have its own risk profile. The firm's business is not a risk-free investment. That means when you discount the firm's future cash flow, you should use a risk-bearing discount rate, which should most likely higher than the risk-free rate, right? Okay, good job. So, well, I recall those kind of stuff from investment for some reasons, okay, for some reasons. So in this capital file, we learn a lot of kind of formulas, right? So we have the determination between these two, okay? We have the idea that to determine a future price from a current time point, okay, for any maturity, okay, we have this very simple formula, okay, according to current spot price. But practically, this formula is not that helpful for us. Okay, we only know that currently fairly say according to spot price, the future price should be like this. But it's not really practical for us to arbitrage if the future price is deviated from this F0. That's one thing. And even if the future price is exactly this price, it's still not practical to us because this price, although it is determined by F0 by time zero, but it will be realized by time t. Right, it will be realized at a time point in the future. Okay, this is the price we need to pay at that time. Okay, although it is already well determined right now. So at that time point, the spot price is not even at zero. Okay, the spot price is kind of ST here. So the the result that can determine our gain and lose with this future contract is not this at zero. Okay, although this at zero determines this price, but this have no matters for our income. Okay, the matters for our income is the difference between these two. Right, whether this future price we determine now is higher than the future than this spot price at that future time point. This will determine our income. Okay, if this is higher, okay, we lose actually comparing to purchase the asset from the market. But if this is relatively lower than ST, right, then we got some benefit with the future contract. Okay, so here is the place for CAPM dividend discount model, future cash flow model. Why? Because you can use this to build a connection between the future price, the spot price in a future time point and the current spot price, right? You have ER here, right? How to calculate the return? Return is price at a future time point versus the price right now, right? -1. That's how you calculate return. So if you have some way, some formula to determine the expected return, you also have some formula to determine the relationship between these two, right? You just replace R with these two inside, right? So CAPM here, it helps us to find a relationship between S0 and ST so that we can find eventually conclude a relationship between F0 and ST. Okay, so the idea to do that is not that hard. Okay, it's not that hard. We still go back to our very conventional arbitrary opportunity argument. Okay, now arbitrary opportunity argument we have two ways, right? Two ways. One is going with spot. The other one is going with future contract. Okay, we want to have the same consequence, which is holding the stock. Okay, so with the spot, we can having our modification with the CAPM, which is like this. So here, okay, to hold a stock, okay, you purchase the stock here, hold it long, or you purchase the stock here without any protection of the future contract. You will spend this amount, right? Then theoretically, we can have a way to build a connection between these two, as long as we restrict our view into expected stock price. Okay, we cannot really predict the actual stock price. This is impossible. But based on the model, we can predict at least the expected one. This expected one have the relationship is at 0 according to the risk level. Okay. So from the expected value to its current value, we should have some discounting process, right? Then the discounting process need us to provide a discount rate. This discount rate, we use it in other models as well when we determine the fundamental of the company, right? And we know that this is definitely not a risk-free rate. This is some rate risk-bearing rate. This is some rate associated with the company's risk profile. Okay, in free cash flow model, okay, I can give you one conclusion. This R is the WACC, weighted average cost of capital, right? So you know that this discount rate is based on the company's operation. Okay, if we just use a simple indicator, okay, we just call this discount rate with risk, we call it K. Then currently the S0 we spend, fairly say the S0 we spend should be equals to this term. Okay, so roughly like this. Okay, all we have here is basically a very quick relationship. We are thinking about that from the expected future time point to now, we will have some discounting. Okay, okay, you can verify this with CAPM. Well, definitely we will have some interest rate remains there. Okay, so that means okay, the S0 and the expected ST, they have a relationship like this. Okay, get it further. And further, the F0 here is the money we need to spend to hold this stock here by holding the future contract. Here, our obligation as a long position holder is to pay F0. This monetary cost can also be discounted a bit. With a risk-free rate. Right, because holding the contract, the contract itself have a fixed price from here to here. The contract itself, right? Recall what we have here for cost of carry. The interest rate we include in cost of carry is a risk-free rate. Because the determination of future price is all depending on risk-free rate. So in another way to understand this, okay, to prepare this amount of money, this F0 amount of money, you need to at least save this amount, F0 E minus RT. You at least save this amount right now in your Yuebao so that you will have F0 at here. Okay? Everything runs well. Okay, everything runs well. Okay. We have the same result holding a stock here. That means the cost of these two ways should be the same. We either save this amount of money in Yuebao so that we can hold a stock by the end here, or we either spend this amount of money to purchase the stock right now and carry it forward to the future time point so that we still end up with holding a stock. Okay? So if the market is efficient, if the market is fair enough, with no arbitrage opportunity, we will have these two equals to each other. Okay, so our conclusion is okay, slightly modify this a little. So we can build up a relationship between F0 and the EST like this. This is our conclusion here. Okay. So this K comes from models like CAPM. This K is the proper discount rate according to the company's risk level. So typically for a stock, okay, a stock, as long as you exist in the market, you do have some exposure to the market risk. That means what? It means your K very likely have a higher beta, positive beta, means in total, your K is basically the ER here. It's larger than RF, right? It means your K is larger than the R. That means your ER minus KT, okay? Once you are talking about a company stock, okay? K should be typically larger than R due to its exposure to systematic risk. And by the end, it makes the F0 smaller than EXT. So we have a terminology for this. We call this backwardation. In Chinese, this is called 贴水. Okay. We do have some rare case that have a negative systematic risk exposure, which typically the gold, right, is a risk. When the risk in the market is too high, people tend to crowd into gold to earn a relatively lower income. So gold is in many cases is countercyclical. Their systematic risk exposure is negative. So in that case, their K is smaller than R. Although it's sometimes counterintuitive that some things discount rate is even lower than risk-free rate, but this is true. Okay, this will conclude that F0 will even larger than the expected spot price. This we call it contango. In Chinese, it's called 升水. Okay, 贴水 or 升水. Okay, you may see that kind of terminology in the future market very, very often. Okay, they are actually talking about these two. Okay. So yeah. All right. So this part is slightly difficult, but roughly interesting, I think. Okay. By the end, we have the relationship between these two. So you finally find something practically can affect you, practically can help you. Okay. Uh, I will have one more thing about this capital. So this one, in previous years, I actually used this use this as homework. But I saw that actually students can tend to submit something meaningless. So I rather do it in a class. I rather do it in the class. So thinking about this question, okay? You have about 5 minutes to thinking about this question, okay? Well, if you can give me some idea for this, okay, maybe I can give you one point bonus. So the question here is about two choices, okay? As a corporate client, you can borrow in cash or borrow in gold. If you borrow in cash, your interest rate is 11 per annum, 11% per annum. If you borrow in gold, your interest rate is 2% per annum in terms of gold itself. That means if you borrow 100 ounces, you need to repay 102 in the future. Okay? So the risk-free rate in the market, unfortunately, is relatively lower than your borrowing rate is 9.25, and storage cost 0.5%. So now I can tell you the answer. I can tell you the answer, but I want to ask you for why. Okay, the answer is that cash loan and gold loan, one is better. There is one is better than the other. Okay, one loan is better than the other. So I want to ask you, tell me why. Tell me why. Okay, you have 5 minutes. So after 5 minutes, we will review the answer. And you can have some good points if you can answer before I review the answer. Okay. Okay, we don't have enough time, so any ideas? Any ideas? Yeah, yeah. Which one is too low? Gold loan interest rate is too low. Why? Mm-hmm. Mm-hmm. So then where is the place for that 9.25% risk of error rate? Uh-huh. Okay. Yeah, I think you give a quite interesting idea. So comparing the two, okay, okay, that's a good idea. Any others? Anyone? Yeah. 嗯哼。嗯哼。嗯哼。嗯哼。嗯哼。So your conclusion is gold loan is better or worse than cash loan? 黄金是 better. Okay. Anyone else? Anyone else? Yeah. Mm-hmm. Mm-hmm. 嗯。嗯哼。嗯哼。嗯哼。嗯嗯，quite close, actually quite close. Okay, good job, good job. So, quite close, but still there's still a big difference. Okay, so let's have some assumption first. Okay, um, we have two choices. Okay, and when we compare the two choices, okay, we try to stand uh, at the same stage, right? We try to stand at the same stage. So let's do this in this way. Okay, we want to borrow the same value in both ways. Okay, we want to borrow like we want to borrow this amount. Okay, no matter whether we go through gold or we go through cash. Okay, so you have two choices. You either just borrow cash, noted in this value. Your borrowing cost is quite straightforward, right? You indicated there you have a borrowing cost of 11% per annum. So you should repay in 1 year. Right. This one, you don't even need our cost to understand, right? As long as you get into this college, you should know. Okay. Second, you can borrow gold that worth the same amount. Okay, let's do a very simple assumption. Okay, let's assume gold price is 1,000 per ounce. Okay, then we need to borrow 1,000 ounce gold. Right. This assumption is kind of random. Okay, you can assume like 110 or like 11, whatever you want. Anyway, you use this total amount 1 million to divide it by the price per ounce. You get the number of ounces you need to borrow, right? So if you borrow this 1,000 ounces of gold, you also need to repay your loan 1 year later, right? Your interest rate in gold is 2%, and means you need to repay 1,000 plus 20 ounce in 1 year. Okay, come to now, we haven't used any knowledge in our course. Okay, we haven't used any knowledge in our course. So next, very good point. We already learned the determination of future price. So this gold is also kind of some commodity can be packaged with a future contract. So we can design a 1 year future contract for gold, right? 1 year gold future. Okay, and with the equation, we can easily determine the future price, right? Which is F0 equals to price per ounce risk-free rate, storage cost, what? Okay, length, maturity. This will lead to a conclusion about okay, that means what? It means if you based on current gold spot price as well as the interest rate, spot storage cost, you should determine the future price 1 year later for a 1 year later contract like this. So if you go with this procedure, okay, you borrow the 1,000 ounce gold, use it for somewhere, okay, comes to 1 year later, you need to repay this amount of loan. And if you use the future contract to make sure that you will have a fixed price to repay this loan, for each ounce of gold, according to this future contract, you need to spend this amount to purchase it. Okay. So in 1 year later, at that time point, you need to spend in total which is this price is the total amount you need to spend to repay this loan through this risk-free future contract. Nothing much difficult, right? This is quantity. This is a price. Okay, you go through this future contract. Okay, this future contract is basically riskless. Okay, by having this future contract, you don't need to worry about the spot price of gold at 1 year later. Okay, so this is like a confirmed or certain cost you can have with a future contract. This and this, which one is larger? This is larger, right? That means what? Means if you borrow cash, okay, repay the loan, your total spending to repay the loan is this amount. But if you go with a gold loan, okay, still you're trying to secure a risk-free, a certain price to repay the loan, then you need to pay this amount. So the conclusion is gold loan is too expensive. This 2% is too expensive. Okay, a small further question. How much is fair? Just by slightly modify this a little, okay, you have this already is incorporated the 2%, right? You just change this to, you have the equation with one unknown number, right? Okay, you replace this number with the cash borrowing cost here. Okay, your conclusion will be, if you can verify, about 0.68. Okay. So good point, good point. Yeah, although the conclusion is kind of in the opposite, but very good point. As long as you're thinking about touch this, you already get very, very close. Okay, you already get very, very close. So here the idea is that through the future contract, you secure a certain way, a risk-free way to repay this gold loan. Okay. In the above, you don't have any risk, any uncertainty in repay this loan. In the bottom here, you also find a way with no uncertainty. Okay. Once you have no uncertainty, the amount you repay should be the same. Still, it's a more complicated high risk, high return principle, but still it is kind of the thing you should understand, right? If you don't go through the future contract, if you don't learn anything about future contract, right? If you randomly purchase a gold from the market, it's not really comparable. Okay, you randomly purchase gold 1 year later from the market, no matter whether the gold is more expensive or even cheaper, uncertainty are there. Okay, from a current perspective, there are uncertainty. You don't know whether the gold price is high or low. But if you go with a future contract, you have no uncertainty. This have no uncertainty. You have no uncertainty as well. These two should repay the same amount. Okay, this example is actually already very close to the real world example. Okay, so now you see we are in Zhejiang province, right? Many companies, many local companies have international trading. Okay, so very likely nowadays, the local bank is even more powerful than before. So if you, as the representative of the company, you step into the bank, okay, the bank will ask you, okay, what kind of loan you want? Okay, you may say that I have the trading with US, UK, but mainly with US, so I use both Chinese yuan and the US dollar. Okay, then subsequently the bank will ask you, okay, we have two offers. Okay, we will offer you US dollar loan with US dollar interest rate. We can also offer you Chinese yuan loan with a Chinese yuan interest rate. Which one you want to choose? Okay, without any knowledge about the future, you are just about like before. Okay, like I described. Okay, on the other side, on the side with uncertainty, you will never know that which choice, Chinese yuan or US dollar, you will never know which law is better. But if you view the other currency, as the gold here, you build the future contract for that currency. You can easily determine that which offer is better. Okay, this is even applicable to your personal financing. Okay, nowadays, I have many friends. They somehow live abroad, or they hold some bank account in other countries. Okay, they have that problem very often, right? Whether they should deposit their money in Chinese yuan or deposit their money in US dollar. Okay, you can have a fair judgment based on this example. Okay, this example is kind of too difficult. Okay, don't worry. In the exam, we won't have this. Okay, in the exam, we won't have this. Although the calculation is not that hard, but the brain power is just too demanding. Okay, don't worry. But I just want to give you some good point to see that how can we apply those theories. Okay, so we have 10 more minutes. So give me five more minutes. I have a small touch on the third chapter. I have a small touch on it. Okay, then we can have our Kahoot quiz. So in the third chapter, the main job is to determine the best hedging ratio. Okay, so in the first chapter, the introduction, we're talking about hedging a little. Okay, but we only brief touch about that. We simplify the question a lot. We say that you just want to have the orange, and there is orange contract. Okay, everything is so well defined. But in practice, the situation can be very difficult. Okay, sometimes you need to close out your future position before the maturity, before the delivery date. There will be some risk for the non-convergence of future price and spot price. And sometimes you cannot even find a proper contract to hedge. In that case, you need to do the so-called cost hedging to find something similar to help your hedging strategy. Okay, so here in this chapter, eventually we want to conclude about how to have the optimal hedging ratio. And today we only touch two small points. Okay, one is about long and short hedge. The other is about necessity of hedging. Okay, so long and short hedge basically say if you take the long position of the future contract, you are taking long hedge. Okay, purpose is also very straightforward. If you would like to purchase in a future time point, you take the long position. Okay, so according to the group assignment, okay, Zhang Yuxin, if you are the orange juice company, you use orange as your raw material. Okay, there is an orange future contract. Okay, should you take the long hedge or the short hedge? Okay, why? Uh-huh. Uh-huh. Okay. 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 That's a good way. That's a good way of thinking. Okay. But I would recommend you to take long hedge because you rather use that as your raw material because your cost, your revenue, your net income is by the end determined by the cost. Okay, so locking your cost is kind of important. If you take short hedge, yeah, it's somehow reasonable. Somehow reasonable. If you have something additional in your inventory, you cannot use it, then using a short hedge position to deliver it to someone else and consume the value you can get. Maybe that's also one way. Okay, good point. So long hedge and short hedge. Necessity of hedging seems like a very straightforward question, and we don't even need to argue about that. Okay, hedging is so obvious. Right? It helps us to reduce our concern on some kind of risk, some kind of factors. Okay, making us can focus on the main business. Okay, but we do have three counter arguments to say that actually hedging is not that necessary. Okay, and those all those counter arguments are very, very strong. Okay, I would say many of them are very reasonable. They do explain some real world difficulty. Okay, Shihan, very simple question. Okay, what is the primary goal of corporate finance? Uh-huh. Okay, so they earn profit for whom? Clients and stock investors. So stock investors precisely says stakeholder. Uh-huh. Yes, roughly correct. Okay, so client plus precisely say stockholder. Okay, in total stakeholder, you tend to bring some benefit for them. Well, this is quite a modernized case. In the most conventional definition, very simple, shareholder value maximization. Okay, in a more conventional definition, you don't really care about other stakeholder like clients. You rather care about shareholder alone. Then the problem is that shareholders, they have their investment in your company, but they can also have their investment in other companies. So they naturally now we know that diversification is such a very simple principle that everyone can achieve by holding enough stock in their portfolio. Okay, and very likely that okay, you can just listen to me and start to scan. Okay, and very likely that the shareholder can diversify enough, and in some cases they hold your stock as a long hedger's stock. They also hold the short hedger's stock. Okay, so in that case, for that shareholder, whether you hedge or not, seems like doesn't matter to them, right? Because they hold your stock, they also hold the short hedger stock. Okay, the sum total to the shareholder is all the same, zero. So the argument here is that since your company need to work for the shareholder, you need to work for the shareholder value maximization, and the shareholder itself can naturally hedge all those risks through diversification. Then what is the point to have hedging by yourself? This is one very strong argument to countering the necessity of hedging. Okay. Second, if you do the hedging, but all your competitors do not, then comes to the market when people trying to investigate your performance, to investigate your risk level, when they're checking your accounting statement, they find that your accounting statement is more complicated than the other competitors. The other competitors, their operations are all so simple: revenue, cost, net income. For you, you have revenue, cost, interest expense, the derivatives cost, and then net income. Okay, you have so many different details. So in terms of accounting statement transparency, okay, you are a bit more difficult for others to understand. Okay, in that case, when people trying to judge a fair cost of capital for you, they tend to assign a relatively higher value. This is detrimental to your stock price. It is by the end detrimental to the shareholder value maximization, right? This is another thing. Okay, once your competitor do not do it, you do the additional work. Sometimes not a great choice. Okay, so a quick check for attendance. 戴诗颖，OK，董子博，黄静雅，江永顺、金伟阳、孔令文、李家俊，刘金峰，对，刘轩宁、刘洋，OK，孟思聪现在的庞碧伦、前一个，哎，I call 前一个，no，前一个 absent，诗涵、王若欣，呀，哦，前一个，sorry，I thought I mentioned you，王心怡，OK，吴敬泽、吴子豪、向成轩，哦好，sorry，杨新奇，杨逸超，于成，OK，于静怡，于瑞思，张雨欣，OK。Okay, all are here. Okay, let's run it quickly. We have only 6 questions. I'm already running out of time, so try to quick. Value future contracts, right? Mm-hmm. Hurry up. Hurry up. I cannot wait the whole countdown. So we already passed time. Hurry up. Okay. Good job. Not off of that. Okay. Oh, this one, I can't understand, right? I'll understand why you're confused a lot.